Welcome to Voyage Daily Tech, the most important news personalized for you every day, supported by Voyage.com.
After listening to today's news, you'll know, first, Oracle's AI business runs on a shocking 14% gross margin, a loss leader strategy to capture the AI cloud market from its rivals. So we'll discuss why this razor-thin margin matters and what it means for Oracle's financial stability and its battle against more integrated cloud rivals. Second, $12 trillion in private capital keeps unicorns off public markets as the median company IPO age jumps to 13 years, creating a two-tiered system. We'll analyze why this is a turning point for Silicon Valley and how it could affect wealth inequality and future investment returns for the public. Third, Zelda Williams condemns AI recreations of her father, Robin Williams, igniting a fight over digital necromancy, legacy, and synthetic performers in Hollywood. Today, we'll take a closer look at this ethical and legal grey area and its implications for celebrity estates and the future of human actors. Fourth, Intel's comeback hinges on its Panther Lake chip, but a reported 10% yield on its 18A process threatens its fight against AMD and Apple. We'll explore how this manufacturing crisis could transform its product roadmap and what it means for its foundry ambitions and US industrial policy. Fifth, a scam as a services trend uses AI-generated founders and fake tragic stories to sell cheap goods, exposing a major regulatory gap in e-commerce. In this episode, we'll break down this new frontier of digital fraud and what it signals for platform accountability and the need for digital watermarks. Let's start with a single statistic that might just change your entire perspective on Oracle. The company's business typically runs on a massive 70% gross margin, but a new report citing internal documents reveals their blockbuster AI business is running on just 14%. We previously analyzed how Nvidia has been widening its moat, and now the cost gravity of that moat is showing up in Oracle's numbers. That figure is a bombshell. This is a classic loss leader strategy. The thinking is that by offering these super expensive AI chips at razor-thin margins, Oracle can lure in high-value clients. Once they're in the door, Oracle plans to upsell them on its traditional high-margin database and enterprise software. It's a huge gamble to get a foothold in the AI cloud market. Continuing our last discussion about buyers like OpenAI playing suppliers against each other, remember, dual sourcing squeezes vendors. Oracle is eating more of that pressure to land marquee tenants. Fundamentally, Oracle is betting its future on transforming into a dominant AI company. The plan is to buy billions of dollars worth of super expensive Nvidia AI chips and rent them out to major clients, including OpenAI for its massive Stargate project. However, if you zoom out, you'll see another layer of strategy at play. This approach effectively makes Oracle a high-tech landlord or a middleman for Nvidia's hardware. When we place Oracle's current state alongside its competitors, the contradiction becomes clear. Amazon Web Services and Google are pouring billions into developing their own custom AI chips like Trainium and TPUs. This gives them control over their supply chain and costs. By simply buying and renting, Oracle faces the long-term risk of being squeezed. A few days ago, we mentioned the broader hyperscaler push to own more of the stack. Today, the focus shifts to the downside of not owning it. On the surface, the strategy looks like a grand slam. Oracle's backlog of cloud contracts has skyrocketed, jumping an incredible 359% in just 1 year, with forecasts of leaping from $10 billion in 2025 to $144 billion by 2030. We've talked about the emerging AI oligopoly. So the backlog isn't the surprise. The surprise is how thin the unit economics look under that demand. But that's not the whole picture. A massive chunk of that projected growth appears to be tied to the success of a single colossal project with one partner, OpenAI's Stargate. The reported deal is valued at a staggering $300 billion, with OpenAI committing to pay Oracle $30 billion a year. The problem? OpenAI's current annual revenue is nowhere near that figure. This has led ratings agencies like Moody's to revise Oracle's outlook to negative, citing concerns over the massive debt Oracle will need to take on. And as we noted a while back, OpenAI has been aggressively dual sourcing to maximize leverage, meaning Oracle's biggest customer will keep pushing on price. The very chips that are fueling this growth are also squeezing the life out of its profits. The high cost of Nvidia hardware, combined with aggressive pricing, has created a major profitability challenge. We previously highlighted that GPUs are only half the story next-gen HBM from suppliers like SK Hynix and Samsung sits underneath those costs, so even upstream memory dynamics can ripple straight into Oracle's margins. Believe it or not, the cost isn't just about the chips. Building out the physical infrastructure for AI on this scale is a monumental undertaking. We're talking about acquiring vast tracts of land for data centers, securing multi-gigawatt power agreements, and engineering advanced cooling systems. These are enormous, hidden operational costs. A while back, we called this the circular economy of AI, which amplifies both backlog growth and balance sheet risk when margins come in this thin. The new wrinkle today isn't demand, it's the math. A 14% gross margin on the Nvidia-powered cloud versus 70% for the broader business. So with OpenAI's deep partnership with Microsoft, why are they even working with Oracle? It's a strategic masterclass in managing risk. The demand for AI compute is so intense that no single provider can meet it. By partnering with Oracle, OpenAI diversifies its supply chain and can play the cloud giants against each other to secure the best terms. We previously analysed this as classic dual sourcing, and it's paired with OpenAI pushing AMD's ROCm as a viable alternative to Nvidia's CUDA lock-in, another lever that strengthens the buyer's hand. Oracle successfully sold the world on its AI vision, but the very foundation of that growth, renting out the hottest technology on the planet, is proving to be a high revenue, low profit game. Speaking of high stakes financial plays, Oracle's gamble is just one part of a much larger story. A $12 trillion ocean of private money is completely rewriting the rules of the startup world, keeping the most innovative companies off the public stock market for longer than ever before. The median age of a company going public has jumped to 13 years, up from 10 years just back in 2018. This means by the time the average investor can buy a piece of the action, the company is already a mature giant. A while back, we walked through Jeff Bezos calling the AI boom an industrial bubble money flooding into tangible build-outs like data centers and GPUs. That industrial scale funding is exactly what lets companies stay private for so long. This trend is creating what some experts call a two-tiered investment system. You see, the most explosive hyper-growth phase of a company where the truly massive returns are made now happens while it's still private. Access is often restricted to wealthy, accredited investors, leaving the public stock market with slower-growing companies. The knock-on effect is a potential deepening of wealth inequality, as the biggest opportunities are captured by a select few, and the size of these private giants is exploding. In 1980, the typical company hitting the stock market had revenues of about $64 million in today's dollars. Fast forward to 2024, and that number has soared to $218 million. This has created a private kingdom of over 1,200 unicorn companies, each valued at over $1 billion. The most extreme example is OpenAI, which recently hit a jaw-dropping $500 billion valuation, all while remaining a private entity. And as we noted a while back, this era is producing very unusual behavior like tiny teams pulling in billions because the race to secure compute and capacity is driving outsized checks behind closed doors. Now, get this, it raises a huge governance dilemma. With these mega private companies holding valuations larger than most public firms, they operate without the transparency we demand from public companies. Critical decisions about AI or space exploration are being made behind closed doors without shareholder accountability. OpenAI's own complex structure, with a non-profit board supposedly overseeing a for-profit arm, has already shown signs of internal tension. This concentration of power is a massive societal risk. So what's fueling this? According to University of Florida Professor Jay Ritter, the old playbook is dead. He states, one of the main reasons for going public is to raise capital. Now, there are a lot of good alternatives without going public. Private equity, venture capital, and sovereign wealth funds are flooding startups with cash, no IPO required. A lot of that cash is earmarked for real industrial scale assets, GPUs, data centers, and infrastructure, which keeps the private flywheel spinning longer. Interestingly enough, a huge portion of this capital is coming from state-controlled sovereign wealth funds, particularly from the Middle East. We're talking about a 5-fold increase in investments into US AI startups from these funds in just the last year. This raises serious geopolitical questions. When a foreign state-controlled fund owns a significant stake in strategic American technology, it blurs the lines between investment and influence, creating potential national security concerns. This has created a gold rush, with private investors claiming they capture all the explosive growth. But here's where the situation takes a more complex turn. That same $12 trillion tidal wave of cash expected to double in the next decade may be its own undoing. We previously analysed Bezos' warning that hype is disconnecting prices from fundamentals, an industrial bubble, not just a speculative one. Some top AI names might carry roughly 30 times earnings, far from the dot-com era, yet the sheer volume of capital can still distort returns. In fact, the same expert who defined the trend is now sounding an alarm. Ritter's analysis concludes with a bombshell prediction for this private market gold rush. His words, "So much money's poured in, I don't expect there to be abnormal returns in the future." That echoes what we discussed earlier. When billions chase both the good and the bad, the edge gets competed away. And that warning is so chilling because of who's at risk. If this private bubble bursts, unlike the public.com crash, a crisis in the private markets would hit institutional investors the hardest, the pension funds that manage retirement money for millions, and the university endowments that fund education and research. According to the IMF, these institutions have poured money into these less transparent private assets. A downturn could leave them facing massive losses, affecting the financial security of everyday people. While venture capitalists are reshaping markets behind closed doors, on the public front, AI is creating deeply personal and ethical dilemmas. The most recent and heart-wrenching example comes from the family of a beloved icon. The daughter of the late Robin Williams has just issued a powerful plea to the public. Please, just stop sending me AI videos of Dad. Zelda Williams is calling out the trend of using artificial intelligence to recreate her father, describing the attempts as personally disturbing. This trend, sometimes called digital necromancy, creates a huge psychological and legal grey area. Psychologists are finding that for some people it brings comfort, but for a significant number, it can actually complicate and prolong the grieving process. A recent Stanford study found 23% reported it made their grief worse. Legally, it's a battlefield. Robin Williams passed away before this tech was mainstream, so traditional right of publicity laws don't fully cover it, leaving estates to fight a digital ghost with outdated legal tools. In a blistering statement, she said, "To watch the legacies of real people be condensed down just so other people can churn out horrible TikTok slop puppeteering them is maddening." So the thing is that TikTok slop gets made and spread so fast because of the algorithms. Platforms like TikTok are designed to reward engagement. Controversial or shocking AI content like a deepfake of a beloved celebrity generates a massive reaction. The algorithm sees that spike and pushes the content to even more people, incentivizing creators to make this exact kind of low effort, emotionally charged content. She didn't stop there, calling the practice a waste of time and energy and something her father would absolutely not want. Her most visceral takedown, she declared, "You're not making art, you're making disgusting, over-processed hot dogs out of the lives of human beings." She then compared the endless recycling of AI content to, in her words, the human centipede of content. After all, she's technically right. Generative AI models don't create from a place of inspiration. They are trained on gigantic data sets of existing human-created art. What they do is identify and recombine patterns from that data. So when Zelda says they're making over-processed hot dogs, she's hitting on a fundamental truth. The AI isn't having a new idea. It's just endlessly remixing what we've already made. And this isn't just about one family's grief. This is the front line of a much larger battle brewing in the entertainment industry. The plea comes as unease grows over creations like AI actor Tilly Norwood, a digital persona its creator hopes could be the next Scarlett Johansson. The Screen Actors Guild, SAG-AFTRA, fired back, stating that Tilly Norwood is not an actor, but a computer program trained on the work of countless performers. They added it has no life experience to draw from, no emotion. This issue is so real that SAG-AFTRA addressed it in their 2023 contract. They now have an official definition for synthetic performers like Tilly Norwood. The new rule doesn't ban them, but it does require producers to notify the union and negotiate before using a fully digital actor. It's a major new front in the fight to protect human actors. Actress Emily Blunt called the idea really, really scary, pleading with agencies to please stop taking away our human connection. While the AI's creator defends it as art that sparks conversation, the core conflict is escalating. It's a fight over legacy, art, and what it means to be human. As the Actors Union put it, the audience has made its choice. They are not interested in watching content that is untethered from the human experience. That debate over synthetic performers is happening because the underlying technology is getting more powerful. But for that power to reach our devices, it needs chips. And the company that once dominated that space, Intel, is in the middle of a make or break fight for its future. To make its last generation laptop chip, the American giant had to rely on its biggest rival, TSMC. Now, after reporting a staggering $2.9 billion loss, Intel is betting the entire company on a single comeback plan. That reliance on TSMC for their last chip, Lunar Lake, wasn't just a small decision. It was an admission that Intel had fallen behind. So this move to bring the next chip fully back in-house is a massive strategic pivot. It's part of a huge plan called IDM 2.0, where Intel is trying to reclaim its manufacturing crown, not just for itself, but to build chips for other companies too. A while back, we walked through how IDM 2.0 is about becoming a foundry for hire. Today, the focus shifts to whether that strategy can be anchored by a flagship of its own. The plan is called Panther Lake. It's a new high-end laptop chip, and it represents a critical moment for the company's survival. This chip is the first major product built entirely on Intel's own next-generation 18A manufacturing process. Continuing our last discussion about Intel lining up deep-pocketed allies like Nvidia and SoftBank, the latest development is that Panther Lake is the first big proof point those dollars were meant to enable on US soil. The promises are huge: 30% less energy use while delivering a massive 50% boost in data processing power in some situations. Now, a 50% performance jump is not a typical generational improvement. For a competitor like AMD, that number is usually around 10 to 15%. So what Intel is claiming here isn't just an improvement, it's a monumental leap. To showcase this, Intel recently held private factory tours in Arizona. And a few days ago, reports said Intel would publicly reveal technical details on Panther Lake, another sign they're trying to reassure investors that 18A is real. That redesigned AI engine they're touting is Intel's answer to the new era of AI PCs. We're talking about a specialized part of the chip called a neural processing unit, or NPU, designed to go head-to-head with Apple's M4 and Qualcomm's Snapdragon X Elite. The goal is to run complex AI tasks directly on your laptop. Intel is making a risky bet on what on-device AI will demand in 2026 and beyond. But what really brought this to a head was a number nobody was talking about on the official tour, the yield. Sources reported that as of this summer, the yield on these new chips was just 10%. That means for every 100 chips they try to make, 90 are unusable. To get those big performance gains, Intel is using brand new, extremely difficult technologies. One is backside power delivery, a completely new way to get electricity to the transistors. The other is using next-generation lithography machines that are barely available for mass production. These innovations are bleeding edge, but they also make the manufacturing process incredibly fragile. It's like trying to build a skyscraper with tools that were just invented yesterday. The pressure is so immense that it's drawing attention from the highest levels. After Donald Trump called for the resignation of Intel CEO Lip-Bu Tan, the administration worked out a deal to transform a CHIPS Act grant into a nearly 10% equity stake in the company. We previously analysed how that initial $8.9 billion position has since ballooned to roughly $16 billion across administrations, less like a bailout, more like a venture bet with national security upside. The situation presents a fascinating duality. This isn't just a grant anymore, it's a direct investment. The US government is now a part owner in Intel's comeback. But the specific performance goals, like the yield numbers or job targets Intel has to hit, haven't been made public. This makes the success of this 18A process not just a corporate crisis for Intel, but a major test for American industrial policy. Intel has spent billions on new factories and is promising a 50% performance boost. But the company's comeback hinges on one critical, unanswered variable. Can they fix a manufacturing process where 90% of their most important new product is failing? Because if they can't, that foundry narrative we talked about stalls before it even starts. Intel's struggle highlights how complex it is to build the hardware for legitimate AI. But what happens when AI gets so simple that anyone can use it for fraud? A new scam as a services trend is showing us the dark side. A company just announced the tragic death of its founder to lure you into a massive 80% off clearance sale. The problem? The founder, the company, and the entire story are completely fake. Meet Eileen and Patrick, the supposed owners of a UK jewellery boutique called C'est La Vie. Their website featured a tear-jerking story. Patrick had died, and a grieving Eileen was forced to shut down their 29-year-old business. This tactic is devastatingly effective because it weaponizes our desire to support small, local businesses. We're psychologically wired to trust them. Research shows consumers associate family businesses with honesty and dedication, with one survey finding 67% of people trust them far more than large corporations. Scammers know this, and they're exploiting that trust by faking the very thing we want to believe in. But here's the twist. Eileen and Patrick don't exist. According to AI experts, their warm, smiling faces are literally too perfect, generated by artificial intelligence. And this isn't just one scammer. We're seeing the rise of a scam as a services economy. There are now toolkits available that bundle everything a criminal needs. AI-generated branding, fabricated backstories, and even integration with dropshipping services. It's like a Shopify for fraudsters, lowering the barrier for anyone to launch a convincing scam with minimal effort. Customers lured in by the sob story didn't receive handmade treasures. They received, in their own words, lumps of resin, plastic junk, and cheap metal rubbish. One furious review says it all. If I could give 0 stars, I would complete scam. This brings up a huge question. Who is responsible? We're in a regulatory black hole. While the financial sector is starting to make banks share liability for certain payment fraud, the e-commerce world is lagging far behind. Platforms that host these fraudulent ads often escape accountability, leaving consumers to bear the entire loss. And this isn't a one-off. Another site, Mabel and Daisy, poses as a mother-daughter clothing brand from Bristol but has a returns address in Hong Kong. Together, these fake UK businesses have racked up more than 500 one-star reviews from shoppers who feel completely ripped off, paying high prices for cheap goods shipped from East Asia. The geography here is no accident. It's a combination of factors: massive manufacturing ecosystems that can produce cheap goods at scale, combined with inconsistent regulations on digital fraud and immense challenges in cross-border legal enforcement. This creates a perfect storm where scammers can operate with very little risk. The deception is so brazen that when one of the companies was contacted, its website briefly changed the founders' names to Alice and Fred before switching back. This is the new frontier of online fraud, where AI makes it possible to mislead the public on an unprecedented scale. As one AI professor warned, the images are becoming so realistic that the challenge is no longer about proving if a site is AI generated, but whether there's actually a real human involved at all. So, how do we fight back? The industry is working on next generation solutions. Think of things like verifiable digital watermarks embedded in images to prove their origin, or much stricter platform-level know your business checks that would force these online stores to prove they are who they say they are before they can even start selling. It's a constant battle, but a critical one for maintaining trust online.
That's it for today on Voyage Daily Tech. Follow, share, and stay tuned for daily updates coming your way tomorrow.